By late 2023, China's A-share quantitative trading industry had swelled into a colossal, highly complex trillion-yuan machine. Then it fractured. Between 2019 and 2021, these models routinely captured returns exceeding 30%. Market inefficiencies were abundant, and simple algorithms easily harvested retail trading noise. But by early 2024, that structural advantage had evaporated. This data from February 2024 highlights the severity of the collapse. While total assets under management reached 1.21 trillion RMB, average weekly excess returns plummeted into negative territory, bottoming out at negative 8%. While 2025 saw a brief spike in performance, this was an asymmetric valuation repair following an extreme market sell-off. The underlying algorithms had not regained their predictive edge. The erosion of excess returns in mid- and low-frequency strategies is a structural evolution of the A-share market. The industry's capacity to generate alpha has settled at a lower equilibrium. To understand why this system failed, we have to look past market sentiment and examine the strict mathematical mechanics of active management. This formula is Grinold's fundamental law of active management. It serves as the definitive mathematical dashboard for evaluating the viability of any quantitative strategy. The left side of the equation is the information ratio, or IR. This represents the ultimate measure of a strategy's risk-adjusted excess return. During the 2024 collapse, this metric essentially went negative. The right side of the equation contains the two inputs driving that outcome. The information coefficient, or IC, measures the algorithm's predictive accuracy. Breadth, or BR, represents the number of independent trading bets the system can make over a year. The A-share quant crisis is a mechanical failure within this exact formula. It is the result of artificially inflated predictive accuracy colliding with the total destruction of trading breadth. In recent years, the A-share quant industry largely abandoned traditional linear factor models. Firms scaled up heavy computational infrastructure to deploy deep neural networks and complex, non-linear machine learning architectures. When these advanced algorithms were trained on historical A-share data, they developed a hidden and dangerous bias. This neural network diagram illustrates how the models processed market data. They incorrectly conflated the extreme idiosyncratic volatility of microcap stocks with genuine, actionable mispricing space, feeding false positive signals directly into the core model. Between 2021 and 2023, microcap stocks experienced a massive structural bull run. This provided a continuous stream of profitable feedback, hardwiring the algorithm's reliance on these specific high-volatility assets. This created extreme style drift. Funds claiming to track broad benchmark indices like the CSI 500 were actually hiding massive concentrated risk exposures in the smallest, least liquid stocks on the market. The exceptionally high information coefficient these models reported was a statistical illusion. They were not discovering true alpha. They were simply taking on uncompensated beta risk. That brings us to the breadth variable in Grinold's equation. A highly accurate model is useless if every other model in the market is making the exact same trade. This scatter plot visualizes factor crowding. When hundreds of funds deploy identical algorithms to chase the exact same limited liquidity pool, they physically exhaust the available risk premium, clustering into a single highly correlated trade. The market saw this exact mechanism in 2020 and 2021. The extreme concentration of capital into a few core asset sectors destroyed the mathematical viability of diversified quant models. Returning to the formula, Grinold's law mathematically requires trading bets to be independent. When homogenized mid-frequency models all buy the exact same assets, that independence vanishes. When algorithms synchronize their signals, the effective breadth of the market drops to zero. Alpha is neutralized, and what began as individual fund risk scales into severe system-wide fragility. In 2024, a wave of new regulatory measures altered the A-share microstructure. Regulators enforced rigid limits on order submission rates and mandated T+1 securities lending. This neutralized the mechanics required for intraday high-frequency trading. The secondary effect was immediate. To survive, large high-frequency trading operations had to abandon their microsecond strategies entirely. Massive volumes of high-frequency capital were forced downward, aggressively flooding into the already crowded, slower mid-frequency trading ecosystem. This was a dimensionality reduction attack. High-frequency teams applied their overwhelming computational and hardware superiority to the slower mid-frequency space, systematically outcomputing traditional funds. This forced migration evaporated whatever easy alpha remained. Surviving in this environment now requires absolute infrastructure dominance, funneling returns almost exclusively to a few top-tier oligopolies. The crowded algorithmic powder keg ignited in early 2024, driven by a sudden macroeconomic contraction. The system was highly sensitive because of underlying leverage. Direct market access, or DMA accounts, were routinely utilizing 2 to 4 times leverage to amplify their alpha margins. This flowchart details the mechanical sequence of the crash. As the broad index dropped below a critical threshold, it triggered mass knock-ins for snowball derivative products. To hedge these positions, institutions shorted futures, ripping the futures basis wide open. That wide futures gap immediately inflicted massive, unsustainable hedging losses on the highly leveraged DMA strategies, triggering severe margin calls. To cover those margin calls, the algorithms reacted mechanically. They indiscriminately liquidated their highly illiquid spot microcap holdings to raise cash. The 2024 crash was a perfect negative feedback loop. Complex derivative leverage and algorithmic homogenization converged to completely annihilate market liquidity. Simple linear price-volume factors are permanently broken and can no longer generate returns that consistently beat the broader market. To survive sudden macroeconomic-style shifts, quant models require strict mathematical upgrades, starting with residual momentum. Statistical orthogonalization acts as a strict mathematical filter, stripping away market noise to leave a clean signal of pure idiosyncratic return. Next, integrating large language models processes massive unstructured data, analyzing satellite imagery for port traffic, running sentiment analysis on earnings calls, and mapping complex supply chains. The information coefficient can only be mathematically restored by abandoning crowded, high-frequency price data and shifting toward deep, unstructured fundamental insights. The decay cycle taught institutional quant managers one final brutal lesson. Scale is the mathematical enemy of performance. If a fund allows its assets under management to grow unchecked, it will inevitably exceed its strategy capacity, triggering another collapse in excess returns. To survive in 2025, top-tier funds adopted a counterintuitive defense mechanism. They executed massive systemic dividend payouts to their investors. These distributions functioned as a mechanical cap on fund size. By returning 17.3 billion RMB to investors, managers effectively froze their AUM to stay within capacity limits. The future of quantitative investing in A-shares requires discipline. It belongs to institutions that prioritize anti-fragile risk models and strict capacity limits over blind asset accumulation.